Hey everybody, it's Mark Yegge here. Welcome to another weekly market update. I'm glad you're here. It's going to be a quick one today. I'm coming to you live from, well, maybe by the time you get it, it won't be live, but I'm in the mountains of Greece, actually, in this old area in the southern peninsula where everything's like castles. It's really cool. So you can see can't see much behind me. There's this big tall tower of a castle, and all around are all these castles. Some are still around, some are like fallen in. It's actually pretty cool. So enjoying a little bit of Greece. Let's jump right into the market. It's been kind of boring, actually, frankly, if I'm being honest. Let's talk about what we just got off our mastermind call. We are in a red market. We've had 4 red days in a row. I suspect a lot of it has to do with this stupid debt thing that they're negotiating with. It's 11:59 before the clock strikes 12. They're going to come up with some deal. They always do. And then we won't default on our debt. But it wouldn't be the first time we're default on our debt. And by the way, we're defaulting on our debt every time we print money. We increase the amount of inflation that we have. That's a default. It's a soft default. You don't notice it because it creeps up on you, except for this last year where eggs are doubled in price. But that's a default. That's all they're doing is printing their way out of debt, but they're not able to come up with the money to pay off the debt because we're not fiscally responsible. We're just keep continuing to spend money. We're not curtailing our spending. In fact, now we can never curtail our spending because the interest has gone up so high on the debt that now we have to print more money to pay the interest on the debt to those people who buy our bonds. And when that happens, you can never catch up because you're printing more and more and more money. Eventually the money blows up. This happens, and this has happened in the last 750 times that we've had fiat currency. And this is not going to be the first time or the last time that it happens. It just happens to be the one we're in right now. So we don't notice it. We don't know when it's going to happen, but it's happening, right? Our money is becoming worth less and worthless. But you can look at it from 1913 until now, which is, basically 110 years. Our dollar purchasing power has declined by 99.5%. A house used to cost $2,400 back in 1920, right? And now, what does a house cost? 400,000, 350,000, something just to get a basic house. So we've lost our purchasing power because the people that we vote for, or if you believe we vote for them, it's a different issue. But they're not responsible. They don't run it like a business. They just, well, we want to spend some money. Let's print some more money. Let's give some more money to Ukraine, where most people can't even pick out where Ukraine is on a map. I'm not saying it's good or bad. I'm just saying we just spend money like it's not ours. And you know what? They don't look at it like it's theirs, but it's ours. We're losing buying power. And if we have a house, we go, oh, my house went up in value. No, it didn't. Your house has the same value. The denominator just got worth less. It's just the dollar value has gone down. So you think you're getting rich if you have a house, but you're not. You're still making the same amount. Well, you're probably making less in real terms than you would be. But anyway, I'm getting off on this tangent. I just wanted to do a quick market update, but you got me going here. So anyway, 4 red lights on the market. We're red, but it doesn't look like they've been drastically red, but you never know what's going to happen with this debt discussion. All right. I'm going to show you some weeklies and some dailies on the charts because the weeklies kind of smooth things out. Take a look at this NASDAQ chart. It's really not too bad. It's coming off of a nice golden cross, several weeks back. It's doing well. It's above the 40-week moving average. It's above the 10-week moving average with support. It's doing nicely. I suspect it has to go through a consolidation here at the 12,269 level, which is right around where it is today. And it's got to get some volume to pop up to that next $13,000 level, but it may do that. But I think we just have to get a lot of this uncertainty out of the way, and we are in May, and May is generally a tough month for the market. Not that matters. But here's what the data looks like. You can see the dailies not quite as smooth, but you can see it's above all the moving averages that I have on the screen. So the NASDAQ is kind of leading everything right now. It was the Dow a little while ago. The Dow is kind of taking a back seat to the technologies. This is the S&P. The S&P is also similarly doing well, just a little smoother and maybe a little bit less volatile, but not quite the same angle of attack that the NASDAQ's doing. But the S&P is fine. Here you can see the S&P. When you look at the dailies, it's got a lot more volatility, right? We had a gap down a couple of weeks ago, gap down. Now we've had some consolidation in there. The S&P is not quite as good as the NASDAQ. All right, let's see how we keep going. The Dow, it was leading for a while. Now you can see there's a little bit of a threat that the Dow, it's right at the 50-day moving average. It wants to go to the 200-day moving average, the black line there. Let's look at the daily. Look at this thing, right? It went and tested the 50-day moving average last week. It tested it yesterday. It's above that today right now, but it looks to me like it wants to be on the lower side of this range, meaning that it may want to go to that 200-day moving average and test that like it did back in March. Who knows? The New York Stock Exchange to me looks the worst. And I could tell you, I think it's probably the worst because it's full of oil, right? And oil has been in a decline because the people are thinking we're going to go into a recession. If we go into a recession, then oil is deflationary because fewer people buy oil, fewer industries use oil. We have less transportation, all that kind of stuff. And so oil is a depressionary or recessionary play on the downside. So it's affecting the New York Stock Exchange composite. The volatility index, though, is telling us, because the lower it goes, the more it says that the market is calm and there's less panic. And this is at the lower end of its range. Now it wants to revert to the mean, but right now it's at the lower end of its range, saying, hey, things are pretty good. And you know what? I don't think we're going to raise rates anymore. The Fed has basically indicated they're not. And if they're not going to raise rates, then that means the housing market may stabilize. The economy may stabilize, although everybody's saying we're going into a recession. I think we're probably already in a recession. But the market is telling us, hey, the market's looking better. And stocks like to climb a wall of worry. So you're going to hear a lot of news, a lot of bad stuff. But based on what we're seeing on the volatility index, stocks like to climb a wall of worry, and things may be going to the upside. We're still in a red market, so I don't know how to square all that. This is kind of a mixed week, as you could probably tell. Tesla is in a downtrend. It's not a very good looking chart. And just not much I could say about it. It's kind of not, doesn't look like it's going down, doesn't look like it's going up. It just looks like it's kind of muddling around. Apple, the opposite, right? This is a beautiful chart. It's approaching all-time highs. It did a one-to-one extension on an ABCD pattern, which you have to watch some of my videos to know what I'm talking about there. But it just hit that one-to-one extension right after numbers last week, and it wants to come down the other side. And it needs a lot of strength to get above this 200, well, what is it, 175, 178 level. It needs some real strength to get up to that so that it can test that 180. That's going to be a real test for it because that's an all-time high. Probably going to be a lot of sellers there, but we need some volume. And if you get volume, this thing keeps going. But right now, I'm not a buyer of Apple just for the short term. Long term, it's a beautiful stock. All right, enough from me. I hope you have a phenomenal week. And I hope that you continue to make money in the market. You know, there's a lot more things that you can worry about other than making money in the market. So I hope you're out there enjoying time with the friends and family that you love so much, and maybe just enjoying your life as much as you possibly can, because that's what it's really all about at the end of the day. Take care, everybody. Have a great weekend. See you next week on the weekly market update.